The days of typing prompts into a chatbot and waiting for text are over. For Singapore businesses, artificial intelligence now executes independent action. Until recently, generative AI operated strictly as a reactive assistant. You gave it an instruction, it generated a static piece of content, and it stopped. Agentic AI operates differently. The 2026 Agentic model sets a goal, plans steps, accesses software tools, and verifies its work. As these agentic nodes replace manual data entry, the nature of your software investment changes. You have onboarded a digital employee. Giving software the agency to execute tasks creates massive operational leverage, but it requires you to manage an entirely new set of risks. The Singapore government is aggressively pushing this transition. The 2026 budget has drawn a clear line in the sand for domestic businesses. For micro and small businesses that usually lack the reserves to test new technology, the government has introduced a $10 million upfront bank financing pool to clear the cash flow barrier. For larger enterprises making heavy tech investments, the expanded Enterprise Innovation Scheme now offers a 400% tax deduction on qualifying AI expenditures. And sitting in the middle, the expanded Productivity Solutions Grant provides 50% direct co-funding for pre-approved AI tools. The government is heavily subsidizing your new digital workforce. But deploying autonomous systems into your daily operations introduces complex integration challenges that a standard software purchase never did. Buying a traditional software subscription is straightforward. Deploying an AI agent requires serious upfront integration costs to map your specific workflows. To see how the government offsets that effort, look at this horizontal bar chart. If you spend $10,000 on a custom AI build, the 400% EIS deduction lets you claim a $40,000 reduction against your taxable income. At the 17% corporate tax rate, you save roughly $6,800. But notice the timeline calendar overlay. You have to float that initial cash outlay for months, sometimes over a year, until your next tax assessment period. Claiming that deduction also requires rigorous accounting. You have to itemize every AI component to satisfy IRA's compliance standards. If you use the PSG route instead, you select a pre-approved tool from a vendor and get direct 50% co-funding, stripping away the heavy custom accounting requirements. The financial subsidies drastically lower the barrier to entry on paper. However, your true cost for agentic AI will be the cash flow management and operational setup required to make it work. An AI agent only provides real value if it connects directly to your existing CRM, HR, or inventory systems to perform multi-step tasks. If you deploy an autonomous agent into messy, siloed, or unstructured business data, it will immediately hit a wall. Software agents lack human common sense. If your foundational data is flawed, they cannot read between the lines. They will simply execute incorrect workflows at high speeds. Before applying for any government grant, audit your current workflows and standardize your data structures. Getting your company ready for agentic AI is a data cleanup project first, and AI second. Because autonomous software carries inherent risk, IMDA has published the mandatory Model AI Governance Framework for Agentic AI to regulate deployment in Singapore. The framework centers on the difference in system authority. This split-screen data table illustrates the core risk. On the left, read access only lets the agent retrieve information. On the right, write access allows the agent to modify a database or execute a payment. If a write-enabled agent makes an autonomous error, the cascading effects lead directly to PDPA liability, compliance fines, and corrupted tax filings. To mitigate automation bias and prevent these runaway errors, IMDA requires a strict human-in-the-loop architecture. In practice, this means an agent can draft a multi-currency purchase order and update the ledger, but a human manager must physically click an approval button before the funds are released. Granting software agency requires a different management strategy. You must architect strict operational boundaries and fail-safe checkpoints to govern its actions. If you run a micro SME, you are already facing high labor costs, a heavy back-office administration load, and tight cash reserves. You should not attempt custom agentic builds or complex EIS integrations. The in-house compliance and oversight required by IMDA will overwhelm your resources. Instead, your immediate strategy should be to tap the new $10 million upfront bank financing to bypass your cash flow constraints entirely. use that capital exclusively on pre-approved, out-of-the-box agentic tools from the Go Business PSG portal. The vendor has already built the governance and safety boundaries into the software. For small traditional businesses, the goal of Agentic AI is safe, vendor-governed labor relief to survive rising overhead costs, rather than risky enterprise-wide overhauls. If you are a medium-sized innovator with established digital systems, you are looking for a technological growth multiplier. This decision tree outlines your distinct path. While micro SMEs take the top branch to safe PSG tools, scaling innovators take the bottom branch, utilizing the 400% EIS deduction to fund custom workflows that connect multiple departments. You must use those tax savings to hire specialized developers who will strictly implement the IMDA governance framework and unalterable audit trails. Once you successfully execute this custom integration, you position your firm to qualify for Enterprise Singapore's upcoming Champions of AI program. Adopting Agentic AI means making a structural change to your organizational chart. You have hired a digital employee that executes tasks instantly but lacks human common sense. Success depends entirely on the rigorous boundaries and oversight you build around them.